Hey, how goes it? Welcome to Dividend Compounders with Cheese. Today, let's talk about Main Street Capital Corporation, ticker symbol MAIN, Maine. Why dividend investors love Maine. And currently, Main Street is trading at about $41 plus or minus a dollar or two. And the thing about Main Street is that it's almost as popular as Realty Income Corporation because of its absolute juicy dividend yield, currently at 6.64%, like a steak grilled medium. In this video, we are going to look at the intangibles, the finances, and run some valuation models to determine if it's a delicious or a disgusting dividend stock. So what exactly is Main Street and what do they do? Main is a business development company, aka a BDC. So in one sentence, Main Street is an investment firm that primarily provides long-term loans and equity capital to companies who otherwise cannot get funding due to their risk profile. So let's break it down even further as to what a BDC is. And while I do that, on your screen, you're going to see the portfolio of all their different clients. So as of their third quarter earnings report, Main Street currently has 195 different clients. What they do is that they provide financing and loans to companies that are considered too small to offer an IPO to go public or too risky by the traditional banks to deal with. Sometimes, by helping these businesses, the return on investment for BDCs is absolutely magnificent. So when we think about Main Street's clients, they are essentially startup companies that need more capital to expand their operations. BDCs, like Main, deal with a whole portfolio of different companies. And so the interest from the loans they lend out to them, it's sporadic. On some months or quarters, Main makes a lot of revenue. And other months, not as much. But from these loans, the small companies can fund acquisitions, leverage buyouts, stand up growth projects, and they can do restructurings. Main partners with entrepreneurs and startups who make annual revenues between 10 million and 150 million. So this is a YouTube channel that is focused on dividend compounders. So let's check out their dividend over the years to see what it looks like. So back in 2013, Main Street paid $2.68 per share as their dividend payout. You fast forward to last year, and now they pay $2.95. So this is hardly any growth, something that you want to keep in mind. And with that said, let's look at their dividend profile. They are a monthly paying dividend stock. That's why a lot of people like Realty Income Corporation, but they also fancy Main. The annual dividend that you get for each share that you own is $2.78 with a dividend yield of 6.64%, dividend growth rate of -2%. This is a red flag. Next, let's talk about their business model and if they have an economic advantage. So BDCs earn income by offering loans and receiving interest payments from those loans, much like banks. So Main Street Capital has two different streams of revenue. Their bread and butter is from investing into those lower middle market companies. And then their side of milk for Santa Claus on Christmas is giving private loans to companies that are privately held by PE firms. So what you see on your screen are Main Street Capital's different clients that are a part of their private credit business segment. So if you look at this company right here, IBML, they are actually owned by Ares, which I'm going to make a video about. And then this one right here, Acumira, they're owned by Peak Rock Capital. These are all different private equity firms. So you have the client that is privately owned by the private equity company, and they get their funding and capital and loans from Main Street Capital. When I was recruiting during my MBA program, private equity, venture capital, and investment banking were some of the desired career fields because of the crazy high compensation packages. So as I scroll down here, I recognize almost every single one of these private equity firms because some of my classmates and friends were interviewing for these companies. But it is important to note that a lot of these private equity firms actually have a very small headcount. So to sum it up, Main Street Capital's business model, Main Street invests in companies that traditional banks won't lend money to. They give private loans to privately held companies owned by PE firms. Next, let's go ahead and talk about their economic moat. And be mindful that there is a ton of BDCs around in the US. And I think this right here is their competitive advantage. In exchange for their financial aid, they take an equity stake in the companies they lend to. Should the companies prove to be successful in the future, their equity stake becomes super valuable. So it's not uncommon to see a $10 million investment into one of their clients become $50 million in a 5 to 10 year horizon. And by taking an equity stake in the companies they lend to, this is how they manage to raise their net net asset value and fortify their balance sheet. Also, unlike other BDCs, Main Street Capital prides itself on being internally managed, which is seen as a net benefit for the investors. Hear me out, okay? Sometimes BDCs are managed externally, and you can see how that would cause a lot of vision problems, financial issues, and risk alignment. We are going to deep dive into this together, but in short, an externally managed BDC can choose to be as risky as they want because their payoff is growth at all costs. So think of externally managed as being more aggressive and an internally managed BDC to be slightly more conservative. All right, so let's break it down even further. So you might be like, wait, dividend compounders with cheese. Why would some BDCs choose to be externally managed? The most popular one is ARC, aka Ares Capital. They have an external management model that allows them to pass on a management fee and carry the interest incentive fee onto the investors, which means the external managers from a venture capital firm or elsewhere on Wall Street gets first dibs on trick-or-treating. Their focus is on gaining more businesses to fall into their portfolios so that they can hit their end-of-year bonus. An internally managed BDC's leadership team, they're going to be more focused on profit growth, not necessarily growing the portfolio, because they are a part of the company. Also, another big call out is that internally managed BDCs, they hire their own staff, analysts, managers, and executives to manage that BDC's assets. Whereas an externally managed BDC, they outsource that task to a third party. Think like a band of consultants, subject matter experts in the industry, various venture capital firm directors, and etc. A second reason that investors might prefer an internally managed BDC over an externally managed one is a lower likelihood of conflicts of interest between management and shareholders. When I read through the externally managed BDC's annual reports, they always have to make that risk disclaimer that there is going to be a conflict of interest between the management and shareholders. For me personally, that is a huge red flag when shareholders are not prioritized. And the last thing that I want to mention is that executives at an internally managed BDC, they tend to pursue growth only when it benefits the existing shareholders and profitability. Externally managed BDCs, where third-party managers are paid based on the percentage of total assets that they have in their portfolio, they tend to pursue growth at all costs, even if that means selling new shares at prices near or below the company's net asset value. When it comes to BDCs, the NAV metric is important. And before I come off super biased, I do want to mention that it's not necessarily a bad thing to be externally managed. It's not like an externally managed BDC is going to intentionally drive the bus off a cliff. I am sure and I am positive that an externally managed BDC's leadership team is still going to be profitable and diligent with their finances. With that said, let's move right along to the downsides and the upsides of Main Street Capital. All right, dividend investors. Downside number one, roughly 10% of Main Street Capital's dividends are qualified, and the other 90% are considered non-qualified and will be taxed at your income bracket. Downside number two, they have a non-existent dividend growth rate. As we saw earlier, it's negative 2%. However, to make up for it, they pay special dividends every once in a while, every 3 months to be exact. A special dividend? What do you mean, dividend compounders with cheese? Well, BDCs like Main have to pay out 90% of their profits to shareholders through dividends. By law, they have to do that. That remaining 10% is really precious to them. Main Street Capital is going to do whatever it takes and forecast to keep it at 90%. So that regular dividend payment that you get monthly is going to be an estimate of how much they need to pay out to hit that 90%. But to be conservative with their numbers, they are going to lowball it just a little bit because they do not want to pay over that 90%. Because remember, they need that precious 10% to grow, to pay their staff, to do this and to do that. So every quarter, Main Street Capital reevaluates to see if they've paid out, say, 87% so far this year. Then what they are going to do is pay a special dividend to catch up to that 90%. I know that was a lot to digest right there. So in short, Main Street Capital pays a quarterly dividend on top of their regular monthly paying dividend because they are a BDC, which means they have to pay out 90% of their earnings. The exact same is true with REITs. So if you invest in real estate stocks like O, this vernacular is probably very familiar. So the next downside about Main Street Capital is that it is a risky industry. BDCs by nature have a lot of debt. Their business model is quite literally to lend loans out to companies that are too risky by the traditional banks. So it's the folks that Bank of America, JP Morgan Chase, Wells Fargo will not do business with. And you might be like, well, hey, Main Street invests in companies that offer both income now through the interest payments on their loans and the capital appreciation later through your equity stake. But you have to remember, the equity stake may never blossom if the startups bust and they just fail. It's like 7 a.m. in the morning. I haven't had my breakfast. I am so hungry. But anyways, their next downside is that they are macroeconomic dependent. Main Street Capital's business model really depends on the interest rates. And right now it's hovering at around 5%. If the interest rates are too high, then it becomes more expensive for them to borrow funds, and it can have an effect on Main's profit margins. And so when you look at their balance sheet, they have a ton of debt, because what they do is they borrow money and then reinvest it into their clients by loaning it out to them. So if you're scared of debt, this is a company you want to avoid. Because let's think about it, right? If you are a struggling startup, you are at a higher risk of loan defaults and even bankruptcy when there is an economic downturn, which means that Maine is also going to be affected. I'm sounding way too negative Nancy here. So let's go ahead and talk about the upsides to Main Street Capital and why it's so freaking popular. Alrighty, now that we got the downsides out of the way, what are the advantages of Maine? Well, number one is their really high dividend yield because they are required by law to distribute over 90% of their profits to shareholders. So their dividend yields will always be juicy. Number two is that you get to be an investor to the private market. By investing in Maine, you're indirectly investing in private companies that are not available on the stock market. And some of these companies have the potential to be 10 baggers, according to Peter Lynch. And in every article that I read about Main Street Capital, always talk about how Main Street Capital's leadership team is best in class. So I guess this is an upside as well. You get a skilled management team that filters out the most risky clients. They don't have to do business with them. I know I mentioned it earlier, but it's worth restating again. They pay a monthly dividend. This is important because it allows you to snowball your drip at a quicker rate, or for you to have a reliable monthly payout. If you like the idea of a monthly paying dividend stock, well then check out my video about Realty Income Corporation. Another positive about Maine is that their portfolio is just absolutely diversified, whereas when I think about their competitor, the externally managed ARC, Ares Capital, they're concentrated really heavily into SaaS, software as a service, and to healthcare. But when you look at Maine's portfolio of clients, they don't have more than 8% in any single industry. But I think out of all of these upsides to investing in Main Street Capital, this is my most preferred and favorite reason. What makes Main Street such a standout BDC isn't its size or its precise business model, but rather its world-class management team, which as of 2023 has one of the best track records in its industry. Main Street Capital's leadership team is just very sound, and they make conservative business decisions to not take on too much risk when evaluating potential clients. If the client's pitch sounds great, but the business fundamentals are not good, Maine will pass them off to another BDC to pick up because Maine is one of the biggest BDCs in the country. They have the power to do that. So how I like to think of Main Street Capital is like Shark Tank, a bunch of startups coming to you and you have the opportunity to invest in them to help them out, or you can just pass off on them. Okay, so we know that the dividend yield is juicy. It sits at around 6.5 to 7%. But how is the performance of the stock itself? Well, what you're seeing on your screen right now is the 10-year CAGR total return. And it looks like they had a 184% return from December 2013 to December 2020. 2023. Year to year, you're looking at a 10.7% CAGR. CAGR stands for compound annual growth rate. Essentially, the rate of return that you see when you reinvest the dividends into the stock to keep buying more shares of it. So CAGR shows you the output when you take into consideration the snowball compounding effect of dividends. So when we compare Main Street Capital to the market using the same time horizon, it does look like Main Street Capital underperformed compared to the market. And when I say the market, I'm referring to VU, which is an index fund of the S&P 500. The market returned 207%, whereas Main Street Capital provided 184%. All right, so that's the total returns for a decade, but what about for 15 years? So for 15 years, this is really where you see the success of Main Street Capital. You had a 1,354% return, and year over year, the CAGR was 19.7%. So the next metric that we are going to look at is the shares outstanding to figure out if the company is issuing more shares and diluting the owners, or are they buying back shares? And this is where I want to throw in this caveat. So Main Street Capital is a BDC, as we've all learned. Issuing new shares is the norm. They need more equity to invest in new deals. REITs operate in the same manner. REITs are always constantly issuing new shares. So when we think about BDCs, adding shares is done by design. This is the business model of BDCs. Just for fun, back in 2010, they had 15 million shares outstanding. When you fast forward to today, now they have 83 million shares outstanding. We're not going to hold it against them because this is the nature of BDCs. And I promise, soon we are going to run some valuation models to figure out the intrinsic value for Main Street Capital. But in the meantime, we are going to take a look at their most recent earnings report investors presentation. So they go on and on about how they are the best of breed BDC. And what separates a good BDC like Main Street Capital from a bad one is their ability to assess the credit worthiness of potential clients and their ability to select when and how to raise additional capital. With that out of the way, let's just go through some of the slides. I know I've been showing it throughout the video, but some highlights include the average loan interest rate for their clients is sitting at 12.9%, which to me sounds very, very high. But to their clients, it's not, so they're paying it off every month. Another call out is that Main Street Capital has never decreased or cut their dividend. However, because they are always issuing new shares, even though they are growing their dividend payment, it becomes diluted. And so the growth rate on paper looks like nothing happened when essentially it is growing. And that's why when you're not looking at a REIT or a BDC, how important it is for companies to buy back their shares so that each share that you own is quality over quantity. You can kind of see the effects here. So I thought this slide right here was important to call out because it's basically portraying their investment income over the years. And currently right now, Main Street Capital are on pace to have a record-breaking financial year. There's 3 more months left from when they measure this, the period ending on September 30th, 2023, and they have basically already hit what they did in the entirety of 2022. With 3 more months to go, I think they are on pace to hit about $496 million in investment income by the end of the year. The last call out that I want to make about their investor presentation is about their cash and cash equivalents on hand. From Q2 to Q3, they raised an additional $7 million, but I want you to take a look at their total debt. They have almost $2 billion of debt. All right, this is my most favorite part of the video. Essentially right now, we are going to run some valuation models to figure out the intrinsic price for Main Street Capital, and then we are going to compare that price to what Wall Street analysts think the price targets should be. So the first one is going to be the multiples valuation. Essentially, we are going to reach an intrinsic value for Main Street based on how the market values other companies in the same industry as them. And the companies that I picked to compare Main Street Capital to are all major players in the BDC space. The median PE ratio for the industry is 7.89, and that's because after the Great Recession, everyone has been bearish to the finance industry. So when you look at some of the major banks, their PE ratios are also single digits. When you look at Morgan Stanley, when you look at Bank of America, and also BDCs, anyone that's in the business of lending out loans. The intrinsic value that we reach after running this valuation model, $38.93. And currently right now, Main Street Capital is trading at about $41. So the multiples valuation valuation model tells us that Main Street Capital is trading at a fair value. But you have to keep in mind that Main Street Capital is the best-in-class BDC. So as a result, investors are willing to pay a premium price to own a share of Main Street. It's like comparing TSM to Intel or AMD to Intel. People are willing to pay a premium for AMD because it's best in class. I'm sorry if you are a fan of Intel, but I think those chips are trash. Alright, before I ruffle any feathers, let's go ahead and move on to the dividend discount model valuation for Main Street Capital. Essentially, we are going to reach an intrinsic value based on its dividend growth rate. So when we look at the past 5 years, it does look like the average dividend growth rate is sitting at 6.59%. I am going to be a little conservative and shave off 1% from that and plug in 5.75%, which gives us an intrinsic value $45.12 for the DDM model, which is roughly about $3 to $4 higher than what it's trading for. The last valuation model we are going to do is the bear model, aka the Benny Graham's valuation model. Essentially, we are going to reach an intrinsic value for Main Street Capital based on its growth rate projection, but also the current AAA corporate bonds yield rate. And when we plug that into the formula that you see right here, the valuation that we reach is $66.13. This is from the bear case model. That is phenomenal. Which brings us to the conclusion. What is the intrinsic value for Main Street Capital? Drumroll please, Jimmy. Ba 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 ba. All right, so the intrinsic value is going to be $50.06. Wall Street says that Main Street Capital is worth $43.20, a low forecast of $40 and a high forecast of $47. So it does look like we are a little optimistic about the future of Main Street Capital. Alrighty, so after hearing everything about Main Street Capital Corporation, learning about the intangibles, the finances, the business model, the economic mode, and more, you are considering buying into Main. Let's figure out the acceptable buy price together. So currently it's trading roughly at about $41. When we bake in a 10% margin of safety, the acceptable buy price is going to be $45. You get a discount of $4. But let's say you want to increase the margin of safety because BDCs are a risky industry. With a 15% margin of safety, then your acceptable buy price is $42.55. But let's see how far we can go. Let's say you want a 25% margin of safety. Then your acceptable buy price will be $37.55. So it does look like last year, December 19th, Main Street was trading roughly at about $35. And since then, it's just been trading sideways. It goes up and it goes down. And so if you are waiting for a 25% margin of safety, $37.55 per share is not unreasonable. After looking at the numbers and their story and their business model together, well, this is a tough one because when I consider buying a stock, my mentality is I don't just think of it as buying into it and hoping that it goes up. My mentality is I truly believe that I am buying into a company, a business with real operations, with a real service, and I'm becoming a part owner of it. And when I think about it that way, I like the company, I like the vision, I like what they are doing to support and to encourage startups. However, at the end of the day, I just feel like a BDC is too risky for me. If I am really infatuated with the idea of receiving a monthly dividend, then I would personally just go with Realty Income Corporation over Main Street Capital. With that said, if for whatever reason Main Street Capital ever does decide to go on a dip, $30 per share with a margin of safety of 40% baked in, then I might consider jumping into it, but buying a little bit here and there. If you like Main Street Capital, then do your own due diligence and research to figure out if it is a delicious or a disgusting dividend company. As for me, I don't think Main Street Capital is delicious, nor is it disgusting. I think it's the same as eating a 3-day-old cheeseburger that's left in the fridge. It's not going to be delicious, but it's also not disgusting. So that's where I am with Main Street Capital. But I genuinely want to know your thoughts. What am I missing about Main Street? Why are you you invested into Main Street? What's good about it? What's bad about it? In hindsight, when I think about my MBA journey, I do have some what if daydreams because I did have an opportunity to join a venture capital firm, but I decided to go in the route of consulting. Anyways, if you made it to this point in the video, would you consider subscribing to the channel? I would genuinely appreciate it. By you subscribing, it would help the channel out a lot because right now it's really small. However, one day I do believe the channel is going to be monetized. And the first upgrade that I'm eyeballing is getting a new microphone to replace this cheap piece of crap that I've been using since the pandemic for my Zoom meetings. Anyways, I'll talk to you next time. This is Dividend Compounders with Cheese, signing out. Stay safe.